See, basically, we are raising primary proceeds of about 1,200 odd crores, and the main objective of the use of proceeds is to reduce part of our debt, and our debt is actually all aircraft-related debt. We don't have any non-aircraft debt. We've never had any working capital loans, etc. So our focus has been on that we've used these primary proceeds, about 1,100 odd crores, to reduce a part of that debt that we have. We have a total of 3,912 crores. So give or take about a third of that debt, or about 30% of that debt will come down.
All right, Mr. Ghosh, also give us a sense on the current market share in the aviation space, on your fleet and your order book as well.
So, our market share is about 36% of the Indian market today. I'm not sure which way market share will go, because we do not chase market share. Market share is the easiest thing to do. You'll see airlines putting a flash sale out there. You'll see load factors go up and people start thinking that the airline is starting to turn around. Increasing load factors is the easiest thing to do. If I want to sell 1 pen versus if I want to sell 10 pens, all I have to do is reduce prices and 10 pens will sell. But that's a sure shot way of making sure that the cash burn and the losses increase. What we are focused on is creating structural advantages, ways to bring our cost structure down going forward. As you've seen, we've created a very successful business over the last 9 years. 7 years in a row, we've been profitable. In the last 4 years itself, we have generated $1.3 billion of cash. We have given a dividend of more than $600 million. This last fiscal year 15 itself, we had a revenue of $2.3 billion. We had EBITDA of more than $600 million. We had a net income of more than $200 million. So we're coming off a very, very strong track record. In the first quarter one of fiscal 16, we have delivered a net profit of 640 crores. Going forward, if everything even remains the same, which means we just get economies of scale and the cost structure stays constant, we've got the NEOs coming in the next few months. The NEOs are expected to burn 10 to 15% less fuel. Fuel is 50% of our cost. So 10 to 15% of 50 goes straight into our margin, goes straight into our bottom line, and our cost structure starts coming down. So if you think about it, we have created a business where the growth is locked in. We have 430 more airplanes to come over the next 10 years. We found a way that the cost structure starts coming in. So even if fares remain the same, the cost structure coming down, the profitability increases. What gives us the confidence? The confidence comes from the fact that we have built a track record, we've delivered, and with a very disciplined business model. And more than anything else, we're in a market, the Indian market, which is highly underpenetrated. A country of 1.3 billion people, there are 391 airplanes, less than that fly domestic, which is about half the size of a Southwest Airlines. This is the sunrise industry which is going to grow.
Talking about the environment, you do have new airlines coming into this space. How do you see competition heating up, and more importantly, how will that affect IndiGo, if at all?
So, competition, irrespective of which color of the shirt it wears or what passport it carries, it doesn't matter to us. For us, we are always going to deliver on the lowest cost structure. Today, when you compare ourselves, excluding fuel, because fuel has these very crazy tax scenarios in various parts of the world, excluding fuel, we are one of the lowest cost structures anywhere in the world, sitting in India. So when a competitor comes in who has advantages of secondary airports and airport incentives and things like that, and government subsidies in other markets, when they come to India and they have to compete in our turf and all those advantages disappear, we not only have a cost structure, lower cost structure sitting in India and them sitting in overseas, but here then the cost structure gap increases even further. So it doesn't matter where the competition is coming from. We actually, with our lower cost structure, always remain ahead. And how can we remain ahead? So primarily driven by the NEOs, as I said. Those NEOs are already sold out for the next 5 to 6 years. So competition cannot get access to those airplanes. Even if they go get leases from the open market, they come at a much, much more expensive price.
Your price band is at a premium as compared to any other airline in the country. Talk to us about the rationale behind this. How do you justify the high price?
We have, of course, gone to the banks, and these are all very, very accomplished international banks who advise not only us but other international airlines around the world, Citibank, JP Morgan, Morgan Stanley, Barclays, UBS, Kotak. And they do their study, and it's based on what they did. based on the tremendous feedback that we've got from the roadshow presentations in the last 4 weeks. And if you see our comparables and we compare ourselves to the Ryanairs and the Wizzes and the EasyJets of the world, and I do not think our valuation is unreasonable at all.
All right, then also now give us a sense on your dividend policy. Why exactly a dividend payment just before the IPO?
So our view on dividends is very simple. We are cash flow generating, we are profitable, we hardly have any capex requirement. Every year we sit down and see what's happening with the marketplace, and the excess cash we have dividended it out, and we've been very, very shareholder focused. We've always paid out interim dividends for many years, and we paid out an interim dividend this year also. We just look at what is the projected earnings, the board looks at the projected earnings, and once they feel comfortable that this kind of dividend has been given out, and we give out the dividend. Of course, it's met by whatever other requirements of the law. The bankers look at it, the councils look at it, the regulator looks at it. Negative net worth is as of that date, which was, by the way, 3 months ago, more than 3 months ago, on the 30th of June. As the cash flow starts building up, that negative net worth becomes positive net worth. We have been around for 9 years, 7 years of profitability, positive net worth always. It is on that particular date, and as the cash flow starts building up, the negative net worth disappears to positive net worth. And finally, it's a firmly held view that the airline belongs to shareholders, whether it is private shareholders or whether it is public shareholders. It is the job of the management team to be shareholder focused, without compromising on what the customer needs, without compromising on what the employees need. And as long as these three triumvirate are kept happy, then that's what IndiGo does.
All right, now let's talk about the way forward then, Mr. Ghosh. Talk to us about your route expansion plans for the future.
India is a very large country with a lot of potential, very little air travel, very few airplanes. We are one of the most under-penetrated aircraft markets of the world. There are 56 airports in the country which can land a 737 or a 320. It doesn't require any further infrastructure development. We fly to only 33 of those destinations. So at 2 or 3 new airports every year, which is kind of our run rate, we have several cities in India that we are not operating to, which are large cities, not just small cities, large cities with a lot of demand. Whether it is Bhopal, Surat, Aurangabad, Mangalore, Trichy, Vijayawada, Tirupati, Jorhat, Silchar, Dehradun, Udaipur, Jodhpur, Leh, Port Blair, you can go on and on and on. There are that many cities in India that IndiGo doesn't fly to, not counting the increase in traffic in the city pairs that we're already flying in. We have a lot of growth opportunity, a lot of runway ahead. So you will soon see that even these planes may fall short. And finally, as far as slot constraint is concerned, there's only one slot constrained airport in India, which is Mumbai. We are the only ones expanding, so we're getting those slots there. So very comfortable with and with what we are doing. Look at the next 20 years. Airline market is growing at 9.5% CAGR. How many industries are there with our kind of scale which can throw that kind of CAGR over the next 20 years? And even if you see the next few years, IndiGo is growing at about close to 18 to 20%.
All right, Mr. Ghosh, before we let you go, we'd also like to get a sense on your sale and leaseback model, and also your maintenance contracts, if you can give us more information on that.
Our maintenance cost is one of the lowest in the world. We enter into maintenance contracts upfront, which gives us certainty of predictability of maintenance costs going 10 years into the future. So that's a great thing for investors. They know that there are not going to be any cost spikes there. As far as sale and leaseback is concerned, 75 of our airplanes are on operating leases, 22 of our airplanes are on finance leases. The operating leases, we just take the plane, sell it to the lessor on day one, get it back, and we amortize the sale and leaseback gain over the life of the lease. So there are no yo-yos depending on how many deliveries. This is just another way of bringing our cost structure down. A lot of airlines try a lot of things. This is one more thing, and that requires a lot of foresight, a lot of forethought to be able to order 100 airplanes back in 2005, have another 430 airplanes on order now, and we look very comfortable with our cost structure, and cost structure going down with the neos coming in.
Aditya Ghosh, President and Executive Director at IndiGo Airlines, thank you so much for speaking to ET Now on your upcoming IPO. So one of the biggest ones to hit the Lal Street in a while. Thank you so much for sharing your thoughts on that.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.